Hello students, my name is Gaurav Bansal, as you know already as you are on this channel. Now we are going to start the second session for our series, and this session will be on the macroeconomics. I hope the yesterday's session on the microeconomics helped you, and as I told you yesterday also that in this session we are largely looking at questions and we are also revising the broader concepts. But if you want in-depth explanation of the concepts, for example Solo model, Harrod Domar model, and there are many other technical concepts, for them there will be separate concept classes on the channel. So I will notify about that, and those will start after roughly 10 days. So daily there will be a concept class for a major concept. Okay, and do subscribe this channel and follow me for regular updates and regular videos. So let us start this session. Just give me 1 second, please. Yes. I couldn't locate this pen. Okay, so our topics in this macroeconomic session are growth, relationship between investment and growth, then national income, then specifically topics related to national income in India, then the theory regarding macroeconomics, and then there are certain growth models which is part of the theory itself. So let us start with the growth. So all of us know what is GDP. Okay, so GDP is simply the total financial value of the output. And by the way, even though you know it, still it is very important to revise it every time. What is GDP? Financial value of total output of what? Goods and services, products and services. In what? In an area. Okay, during 1 year. So this is the standard way we look at GDP. Now why did I write? Because there are 4 points here. First of all, GDP is a financial value. So that means GDP by default is a nominal value. What is nominal? What is real? Very swiftly I will discuss. So it is a financial value. Any value which is purely financial is a nominal value. Okay, it can change with the change in money supply. Inflation. Anything which inflation can directly affect is a nominal value. Simply the rule. We need to change it to real. Then it is the value of total output, means production. Then value of what? Goods plus services that we produce within any area. It can be state, it can be nation, it can be even continent. Okay, Asian GDP you can talk about. You can talk about any of the type of the area. Then during, you can also have city GDP. Okay, for example, Mumbai is the largest city by GDP ranking, and during 1 year, this is the standard way. Okay, so there are 5 specific parameters. That is why I always write it down. And even though you know it, some of you may be feeling कि ये क्या पढ़ा रहे हैं, ये तो सब हमें पता है, बंद कर देते हैं वीडियो. Keep continue, because even if I am teaching it for 10 times to you, this at least 1 line I will repeat every time. Why? Because you need to just set it in your mind, so that even in your sleep you remember all the 5 points, because it is such a fundamental aspect of the macroeconomics. Now let us move ahead. So we have discussed broadly what is GDP. Now how do this GDP increase? Production increase when there are more factories, when there are more offices. Okay, simply that is the fundamental rule. So how will there be a growth? Okay, growth is simply increase in this GDP. Growth happens when there is increase in GDP. That is why we discuss GDP. When there is increase in GDP, we call it growth. How there will be growth? How there will be increase in GDP? When there are more factories. How you can have more factories? In order to open more factories, more workshop offices, you need to spend some money, and that money is called investment. So this is the relationship between these 3 topics: growth, investment, and GDP. Okay, first, what is GDP? Then increase in the GDP is growth. And how do we achieve growth? By investments. Investment is the most important and the primary factor behind the growth. Now, what are the different types of investment? The types of investments are fixed investments, then there are inventory investment and human capital investments. So, when you are opening a factory, you need to spend on three different resources. Fixed investment, which are in plant, machinery, okay, and tools, etc. Then there is investment in inventory. Inventory is investment on raw material. You spend a lot of money initially on buying raw material, stocking them, packaging material. All of that is inventory investment. And human capital investment, you spend a lot of money to acquire certain people in your company. Okay, you spend money on them to improve their quality. That is human capital investment. It is not the money you spend on their salaries, because that would be expenditure on the factor of production. Factor expenditure is not investment. Okay, remember that, because factor expenditure is reoccurring. Every month you have to pay salary. But if you are spending some money on a training program of your employees, that is one time, and that will permanently improve their quality if it works. So that way, there are three types of investment, and there can be PT questions on this also. Okay, fixed investment, you can later on refer to this, as I told you yesterday also, or maybe I forgot to mention it, that the PPT we are discussing here will be provided to you. The link will also be under the video, and it is also in my Telegram group. So if you are a Telegram group member, you will get it a day before. If you have not joined Telegram group, I will provide the link of Telegram group in the description, and also in the comment. You can join it from there. You can get the questions there in the Telegram group 24 hours before the video is uploaded. So that way you can practice the questions I'm going to discuss in the video beforehand, and that way there will be better engagement in this class. Okay, and you can also read some of the notes that are provided here. Okay, now let us move ahead and look at the questions. Okay, now let us look at the question on the growth and investment topic. So first, which of the following is not a direct factor that affects the economic growth? Direct factor is very important, because indirectly there are a lot of things that can affect economic growth. Okay, so population growth, is that correct? Population growth is a direct factor that increases the economic growth. Okay, because it can increase production, because there are more resources available. Okay, investment in physical capital, obviously opening more factories. Okay, that is something we discuss in the investment part. So population growth also is favorable, physical capital increase is also favorable, technological progress is also directly improving the production. Okay, so for example, we talk about Harrod-Domar model. Harrod-Domar model gives us an equation that growth is equal to investment divided by ICOR. Well, Harrod-Domar model doesn't give that equation directly. Okay, if you look it out on internet, if you search online or in books, the Harrod-Domar model gives you similar equation, but this is the modern interpretation of Harrod-Domar model. Okay, for example, if you check online, then Harrod-Domar model would give you an equation that would look something like this. Okay, let us say delta y upon y, okay, or y dash upon y is equal to 1 upon small k, which is fixed, then delta big K upon K. This is the equation you will find on internet, but you do not have to bother with this. This is the interpretation of Harrod-Domar. Okay, those who are reading it for the first time. My students, those who have taken classes with me, know about it. So some of you might be just watching it again. For you, it is a revision. So growth is equal to investment divided by ICOR. Plus, it also assumes increase in population. So that is also there. Population increases, capital increases, means labor capital are increasing in the economy. Okay, and then there is given ICOR. ICOR is an indicator of technological progress. incremental capital output ratio, it is given to be fixed. Okay, it doesn't change in the short run. So for example, ICOR is simply how much extra capital is needed for one extra unit of output. For example, in order to get 1 crore rupees of extra output of steel, how much I need to spend on a factory today. For example, I need to set up a factory for 70 crore rupees and it give me output of 10 crore rupees every year. Then my ICOR is 7. Okay, incremental capital, extra capital which I spent on setting the factory is 70 divided by incremental output, that is 10 crore. Incremental means extra capital spent divided by extra output received, and that is 7 in this case. So technological progress improves ICOR, reduces it. So that is also in a way part of the growth. Okay, so Harrod Domar model is one of the most basic model of the growth. So growth is dependent directly on population growth, physical capital, technological progress. Political stability is very, very important, but it is something which is not measurable, not even coverable inside our models. So it is not a direct factor. So over here answer would be 4 only, C. Many of you could actually be choosing 1 and 4. Okay, a lot of students would have problem between A and C in this question. Okay, but I hope now it is clear. Next question. Okay, and coincidentally there is some problem in the numbering here. Okay, on each page I generally put 2 questions. So in this case, since I provided only 1 question on the page 1, on the second page I made an error and there is directly a question number 3 after 1. So just pardon me for that. There is no question 2 here by chance. Which of the following is not an indicator of economically developed nation? Okay, high level of literacy is an indicator of economically developed nation generally. Okay, low birth rate, generally an indicator of economically developed nation. Okay, generally. Higher proportion of labor in tertiary sector, not necessarily, but it can be an indicator. There is no problem with that also. It is not necessarily required, but it may very well be there. Okay, for example, in Germany, for example, in many of the industrial countries, the C is not very high. Okay, proportion of labor in tertiary is relatively lesser. Secondary is much higher. So that is also possible, but there is no problem. Okay, it is generally an indicator of a better of economy. High proportion of labor in primary sector, agriculture, mining, okay, that is generally not an indicator of a economically developed nation. So D would be the answer. Some of you may have confusion regarding the birth rate. Some of you, most of you should get it all right, and a few of you also may have confusion between C and D, although it was an easier question compared to the previous one. Next, which of the following is not a necessary requirement for economic development? Temperate climate, natural resources, adequate capital base, technological advancement. Okay, so capital definitely required. Okay, it is almost impossible to find a country, rare exception we do not consider, where a country has become rich and there was no capital base. It grew primarily without capital. That kind of examples are not there. Okay, generally technological advancement is there, is a part of the growth. Okay, rarely you can just labor yourself out of poverty. Natural resources. Now there are many examples where countries which do not have much natural resources yet have become much developed. Okay, Japan, South Korea, Singapore, all the Asian tigers. Then there are many other countries also, okay, even in Europe. So it is not a necessary requirement, although even if we have natural resources, it really helps. Okay, so country like China, etc., it really helps. Then there is this temperate climate. These are basically old theory. 100 years ago, if somebody would make a list of necessary requirement for economic development, they would include 1 and 2. But in the previous 100 years, we have seen many examples where countries grew without these. Earlier, generally, the countries grew with these. Okay, so in this case, not a necessary requirement would be 1 and 2. Okay. 3 and 4, we do not have much example. That is why we consider those to be necessary. 5th, which of the following is a factor that affects the investment? Okay. Is not a factor that affects investment. So interest rate affect investment. Okay. If interest rate is high, it is expensive to get funds, then the investment is low. Okay. Interest rate are very, very important for investment. Then there is this business confidence. Okay. Business confidence also matters and is a factor that affect investment. Even political stability also matters for investment. Okay. It is not directly responsible like the other two, but it is definitely responsible. Foreign exchange rate is something that is not responsible. Some of you may have confusion between C and D. D is the answer here. Foreign exchange rate. How the dollar is changing versus pound. Generally, that should not be a factor which should affect investment here. Generally. Okay. So, anything can affect investment in India, by the way. Any development. Okay. Even an earthquake in Chile can affect investments in India by very small margin. But still, overall, this will have the least impact. That is how we can also see. So, answer should be D here. Question number 6. Which of the following is an example of a fixed investment? Okay, fixed investment is what? Fixed investment is investment in plant, machinery, etc. Okay, immovable physical investment. That is fixed investment. Buying stocks in a company, that is a financial investment. Okay, that can change very quickly. So it is not fixed. Your money is not stuck there. Your money you can withdraw whenever you want. But fixed investment, you established a manufacturing plant. It is not so easy to get out of it. B, investing in a mutual fund, same thing. Okay, financial investment. Purchasing a new factory is a fixed investment. Okay, but let us look at D also. In the previous session, I made this mistake looking at half the information, and it happens to all of us in real conditions. D, holding cash in bank account is also financial investment at best, if we consider it investment. So C is the answer. Okay, I think this was the easiest one so far. Let us now move to the next topic. Okay, next topic is national income. This is one of the biggest topic regarding the questions. Maximum questions generally come from this topic, and there are many concepts here. So GDP as a concept I already discussed, so I will not discuss that again. Okay. Then there are GDP calculation methodologies. There is production approach, there is income approach, and there is expenditure approach. What is this? In the expenditure approach, we look at what people spend. Okay. We calculate the overall expenditure of the people. Expenditure approach will give us the revenue. Revenue of businesses. Okay, what we spend is basically revenue for the companies, firms. So revenue for the firm or the private sector plus government sector. Any kind of business, if government is running business, that will also be part of it. So revenue of the businesses is what we get through expenditure approach. And since when people are spending their money, there are indirect taxes involved in that stage. Okay, when we are buying something, we have to pay GST also. So in the expenditure approach, indirect taxes are part of the price. So expenditure approach is going to give us GDP at market price. Expenditure will always be at market price. Okay, so expenditure approach method gives us GDP at market price. Income approach. In the income approach, indirect taxes are not included. Okay, because we have not spent that money yet. We have just received our money from our employers. Here we are not spending the money, here we are earning the money. So taxes are not yet part of the picture. Okay, savings are not yet part of the picture. So income approach actually gives us GDP at factor cost. Okay, because instead of looking it from our perspective, people's perspective who are getting income, look at it from firm's perspective, company's perspective. Our income is expenditure for company. Our expenditure is income for the company, okay, revenue for the company. So in this case, our income is basically factor cost for the company. Company has two major costs. One is factor cost, other is raw material cost. So income is basically the total of factor cost of the company, what it paid as salaries, wages, profits, okay, what it gives to its owner back as profit, what it pay as interest to the people from whom money is taken, what it pay as dividend to the shareholders, what it pay for the rent for its offices. So that is there in the factor cost of the company. And for common people, this is their income. For household, they get their earning from salaries, rent, interest. So look at it, it is GDP at factor cost. For companies, it is the cost for the hiring factors of production. So income approach gives us GDP at FC, and same is with production approach. Production approach is also going to give us GDP at FC. Okay, so this is what we get. So there are two basic measures, GDP at MP and GDP at FC. Okay, GDP at MP measures the revenue of the business sector, and GDP at FC measures the income of the household sector. That is the fundamental difference between the two. GDP at MP, revenue of firm. We do not use the word income. Sometimes we use, but it is not technically correct. Revenue of firms. And this is income of household. Okay, generally this is how we consider. And how do we relate the two? GDP at MP is also equal to GDP at FC plus net indirect taxes. Okay, so this is what we have here. So this is the fundamental relationship between the GDP at MP and GDP at FC. And we get them from different data. In India, before 2014, we were using GDP at FC. After 2014, we are now using GDP at MP. This is the national income measure in India. Okay. So this is a change we made in 2014 on the basis of the recommendation of the Rangarajan committee. Now you may think, sir, Rangarajan committee to poverty pe hai. Ye bhi Rangarajan committee hai. Okay, so this is also Rangarajan committee, even if there are more Rangarajan committees. So I hope this is clear. Okay, similarly there is a difference between GDP and GNP. GDP is gross domestic product, production within the boundary of a country. Okay, it is a geographical perspective. Whatever is produced in an area, irrespective of who produce, whether Indians produce or foreigners produce after coming to India, whatever is produced within India's boundary is GDP. And whatever is produced by Indians, irrespective of where they are producing, even if an Indian is going to Singapore to work on a project for 2 months, whatever retained money they earned from there, that will also be part of GNP. National income basically looks at the citizens. Okay, how much the Indian citizen plus residents earn, okay, in a year. Indian citizens who are also residents of India. NRI's income has nothing to do with this. NRI are completely living in another country and they are contributing to that country. Citizen plus resident. A person must be both. Okay. So foreigners who are coming to India, working in India, contributing to Indian production, that will not be part of India's GDP as per GNP. Okay, so GNP is much more complicated to calculate. GNP look at people's perspective, that what people of a country produce, citizen plus residents of a country produce. Okay, those who are both citizen and residents. Whereas in the first, we just look at residents. Okay, anybody can be resident. So if you are citizen of India, it doesn't matter you are citizen or not. If you are residing in India and you are producing within India, whatever is produced in India will be considered. You go to Singapore, produce there, doesn't matter, we do not count it here. So only the production within Indian boundary will be considered in domestic product. In national product by people. So that is the criteria. On that basis we get GDP versus GNP. And then there is one more criteria, GDP versus NDP. So this is from depreciation. Okay, so GDP is equal to NDP plus depreciation, or from GDP if we minus depreciation we get NDP. What is depreciation? Depreciation is basically the money that we are allocating for future investments. Since we are allocating it for future investment, this money is not going to be consumed by people today. So this money will not affect welfare of people. This much resource is not going to affect welfare. Okay? So depreciation is retained by the companies. This doesn't go to people. Depreciation companies retain. एक कंपनी की फैक्ट्री है, कंपनी ने कहा कि फैक्ट्री हर 10 साल में हमें बदलनी पड़ेगी, इसकी मशीन बदलनी पड़ेगी. उस मशीन को बदलने का कॉस्ट है 50 करोड़. There is a factory which is there in a company. Okay, if I am saying something in Hindi, generally I will repeat in English also, so do not worry. So if there is a company has a factory needs to be upgraded every 10 years, and it costs 50 crore. Suddenly to arrange 50 crore is very difficult. So what this company does, every year it allocates 4 crore rupees or 3 crore rupees. Okay, at the end of 10 years, it will also earn interest on that. Okay, let us say it separate 4 crore rupees every year. At the end of 10 years, it is likely to have something like 60 crore rupees because of that. Okay, because it will also make some return also on that money. Even if you do not consider financial return on that, let us say every year 5 crore you allocate. So it is much easier to do right from beginning than to suddenly arrange money later on. So that is depreciation. Company keep that aside. कि ये तो हर साल मेरा जो प्लांट में डैमेज हो रहा है उसके लिए मैं अलग रख रहा हूँ. That we are keeping it aside for the damage in the plant. So that is depreciation. So these are the 3 major functions because of which there are different numbers or different types of elements in GDP. And if you want detailed discussion on GDP, there will be complete video just on GDP very soon. Okay, most probably around 15th of May. So over there I will discuss all the 8 measures will complete detail, but since this is a revision class I will move forward. So we have discussed the GDP measures, all the possible major concepts related to the measures. Now there are other concepts. Okay, we have discussed the approach to calculation, major, measure. Then we have to discuss GDP versus GNP, that also we have discussed. Then what is included in the GDP, then what is base year, what is real income, okay, and what is personal and disposable income. So that also we need to discuss. So I am erasing all of this and I am going to the next. This is the biggest topic in this session, by the way. In rest of the topics we are not going to spend that much time on the theory. Now real and nominal. By default what we collect is nominal. Nominal is what? Nominal is any value which is affected by inflation. Directly. Affected by inflation simply. Okay. So price, obviously price is what creates inflation. So prices are affected by the money supply, and they basically money supply creates inflation, more money supply, and inflation is what gives us the difference between nominal and real. Real values are those which do not generally change because of inflation. Okay. So for example, in an economy, prices are rising rapidly. As a result, people ask for higher income. Income also increase. Okay. So income that way, what people get as cash is basically a nominal variable. But when these people go to market and buy things, they find, let us say, in an economy, prices are increasing at 20%. Now in this economy, if a person's income, which was, let us say, 80,000 rupees per month, now it becomes 90,000 rupees per month next year. Is this person better off or worse off than earlier situation? Answer me. If you look at just the cash income, this person is better off because he is earning more, or she is earning more. Rather than 80,000, the person is now earning 90,000. But if we consider inflation, price change, then we will find that earlier what this person was buying for 80,000, now the same bundle, because there is 20% increase in price, cost 96,000. Okay, in order to buy the same product basket, same things which this person was buying earlier, now this person needs much more income than this person is getting. So in real sense, this person is worse off. Okay. So what is nominal? Nominal which is affected by price change. Real which is not affected by price change. Okay. So we adjust for the price change, then we get the real variable. In the life, all the numbers that we deal with are by default nominal. Everything is nominal. Okay. In reality, we do not deal with real variables. Remember this line. This will ease the life out for you. Okay. वास्तविकता में हम real numbers का प्रयोग नहीं करते. I mean, real variables का प्रयोग नहीं करते. Real numbers, of course, we do. I mean, if we go in mathematics, then on entire real analysis, okay, complex numbers, imaginary numbers, all those things come into picture. Whole numbers, fractionals, fractals. Okay, that's a fascinating field in itself. Coming back here, I'm talking about real variable. So here, every single variable that we generally consider in an economy is normally a nominal variable. So GDP that we calculate is also nominal, by the way, because everybody's income is nominal. We have already discussed, and sum total of everybody's income is GDP simply. So that will always be nominal. So the data we collect is nominal, but we have to convert it to real. Okay. Nominal needs to be converted into real. And how do we convert it into real? For that we deflate. For example, here, if I want to check the real income of this person next year, okay, let us say year 1, 80,000, year 2, nominal income is 90,000. But what is real income? Real income in this case would be 90,000 divided by 120 multiplied by 100. This will give me the real income of this person. Okay, how much is the purchasing power of this person today? So that is how we get. So if I do this, I will get something like 76,000. Okay, if I divide 90,000 by 120, in fact, I will get 75,000. I will get 75,000. So if you look at the real income of this person, the purchasing power has decreased. The person's real income has now gone down to 75,000. So we adjust it for inflation. We divide it by a deflator and we multiply it by 100. Okay, so that is how we do it. So in order to create that deflation, we need a base year when the inflation is considered to be zero. I mean the starting point when we consider the original prices. After that, each year this base keep on increasing. So this is more technical. If we really need to understand it, again we need to spend more time, and there will be concept class on that. Okay, there will be separate concept class on measures. There will be separate concept class on the other aspects of GDP. So I will take at least 3 classes, concept classes on GDP. Since this is a revision, I think already we have discussed fair bit of real and nominal here. So here real income will be 75,000. Still, if you have problem, come put it in the comments. I will try to help you out. Okay. So This is real and nominal variable as well as real and nominal GDP. By default, the data collected is nominal. We have to convert it into real. All the growth numbers that we talk about, that India's growth is 7.5%, 6.5, 5.8, that is real GDP. We always talk about real numbers. If you look at in nominal sense, then our GDP is actually growing at the rate of something like 15%, 17%. Okay, our nominal GDP increases something like 15, 17%, but real GDP increases something like 7%, 6%. So that is the current performance of India. Okay, per capita income is simply your GDP divided by population. I think I need not discuss it. So I have discussed the per capita income base here. Personal income and disposable income I will cover. Okay, now let us look at questions. Because already there is a lot of time on theory and I need to move to question quickly. Which of the following is not a method for calculating national income in India? So we use income approach, expenditure approach, production approach. All three are used. Okay, production approach is sometimes also called value added. Never confuse here. Okay, sometimes in some of the books, value added approach is also used as a term. So which is also fair. But there is no market approach that we use in India. So in this case, this is the answer. I think this is fairly easy. Okay, it is largely for your revision. I do not think you would get it wrong in general. Which of the following is not a component of the GDP? Consumption, government spending, investment, trade balance. Which of the following is not a component? Take your time, take 2 seconds. If you break down GDP, okay, it can be divided into consumption, which is generally by household. Okay, whatever we spend for consumption generally goes to part of GDP. Government spending is part of GDP. Investment is definitely part of the GDP. Okay, from GDP only we create investments, whatever we produce. Whatever we produce, only from there government spend the money. Okay. Trade balance. Now what is trade balance first of all? That is the difference between export and import. Now exports are part of our GDP, but imports are not. That is why trade balance will not be a component of GDP. Okay, because in trade balance we use the export minus import. Imports are not part of GDP, exports are. So D would be the answer. Some of you may have a doubt in B. Okay, government subsidy specifically is not component of GDP. But over here government spending is given. We can choose government spending also. Okay, we can assume that we are talking about subsidies, but ideally you should not assume anything. Just use the information given in the question. If you absolutely can't find an answer, for example this D is not there, and instead of D trade balance it would be written none of the above or all of the above. If none of the above is written, perhaps you can choose none of the above, but if all of the above is written you have to choose B, because some component there is bit of a doubt in B, so you can choose B then, but D is the answer here. Next, which of the following activity is not included in the calculation of national income of a country? Okay, very easy, but again these type of questions are required for practice. Maid working for family on full-time basis, is it? Yes, because she gets salary and she is contributing something. Generally when you are in doubt what is included, what is not included, use this criteria. It should be paid for. Okay, person who is providing that good or service should be getting money against it. Okay, it should not be free. Secondly, it should lead to some production. It should not also be possible that somebody is getting paid without working. That will also not be part of GDP, because it is financial value of the production of goods and services. When you are not producing goods and services, how it can be part of GDP? Okay, so that is why that all the 5 criteria are very, very important. I go back to it just for 1 minute. financial value of total output of goods and services in an area during 1 year. Think about these. You will never get in problem. Okay, this is absolutely complete formula. So she is contributing to, or he is contributing to production, providing a service and getting paid. Lawyer conducting their law practice standard, providing a service in the economy, generally getting paid. It is nowhere written providing free service. Housewife performing household chores. Now that is where there is a problem, because generally housewives are not paid for their work. Okay, so this is the problem. Unpaid work is not part of GDP. And unaccounted money means money received without working. That is, gift is also not part of GDP. Dispensary rendering medical service, again a service. So C is the answer, I think quite straightforward. Which of the following statement is accurate about the relationship between indirect tax and subsidies? Okay. We have written GDP at MP is equal to GDP at FC plus net indirect taxes. Okay. Net indirect tax. What is net indirect tax? This is equal to indirect tax minus subsidies. Now, what is the question saying? Relationship between indirect tax and subsidies. Okay, we have to look at the options. If the factor cost is greater than market price, okay, this is greater than this, okay. GDP at factor cost is greater than MP. Okay, in that case, look at here. If this number is greater than this, then net indirect taxes must be negative. Because if this number is already greater, then for this equation to be complete, we must be adding something negative to it. And when it will be negative? When subsidies are greater than indirect taxes. Then indirect taxes are less than subsidies. Actually, this statement itself is correct. So A gives us answer. Okay. From two equations you get this answer. If the factor cost is greater than market price, okay, first part is same. Indirect taxes are greater than subsidies. Not possible. If this is greater than subsidy, this will also be positive number, and this is already bigger than this. We add something to it, it will be even bigger. So not possible. And same way you can work out the third one also. So in this case we are very, very confident, very clear, because it fulfills every condition. Anyways, let's spend 1 minute. If the factor cost is greater than market price, then indirect taxes are equal to subsidies. Still not possible. Next question. Increase in the income due to increase in prices will only increase the... Okay. Now income is increasing only because of increase in price. Okay. Somebody is, let us say, a shopkeeper. Shopkeeper sells products. Now every kind of price is increased. Shopkeeper was buying things at 15 rupees and selling them at 20 rupees. Okay, this was the trade. And every month the shopkeeper was selling, let us say, 1000 products. So earlier the shopkeeper was making 5000. Now this price increases to 20, cost increased to 20, output increased to 25. Okay, product price increased to 25, everything increased by 5 rupees. What will happen? You are still making 5000 rupees. You are still not better off. Okay, so increase in the revenue is there purely because of price increase. Earlier the shopkeeper had revenue of 20,000 rupees. Now shopkeeper has revenue of 25,000 rupees, but it doesn't make a difference to the person. So increase the national income at base year prices. What is base year prices? At base year price, it means real income. Okay. If we do not allow price to increase, still output increase, that is real GDP. So if that increase, that means there is increase in real income, which is not the case here. Okay. Another example I'll give you, in fact this is more complicated. Simply consider inflation is 10% in the economy. There are government employees who get dearness allowance. There is no promotion or other increment. There's just dearness allowance of 8, let us say 10% is there. So person was getting 71,000. Now because of 10% dearness allowance, the person is now getting something like 78,100. Okay. So this person's purchasing power is still the same because his costs have increased by 10%, his income has also increased by 10%. So in real sense he is not affected. Okay. In nominal sense income might have increased. So this leads to increase in nominal income, cash income, but not the purchasing power. Real income is purchasing power and nominal income is cash you get. Increase in the nominal national income, that is correct. See, increase in the national income at constant prices. Base year price, constant price is same. What is constant price? Constant price means fixed price. Fixed means we have to take particular price, and which is the price? It has to be a certain price. So whatever price we make fix, that year become base year. So base year price, constant price is the same thing. Real income is also received only when we fix the prices in certain base year. So A, C and D are the same statement written in different ways. Answer should be B. 6. Example of a real variable is wage rate. Is wage rate affected by price? Yes, affected by price. Price of corn, price automatically is a nominal variable. MCLR. Is MCLR a real variable? Well, MCLR is a good example of a variable which is very close to real, okay, because it is percentage. MCLR is rate of interest. Even if price increase, the percentage change, the interest rate, they do not directly affect by prices. But this very easily can be the answer. MCLR is a good answer, by the way, for this one. But let us look at D, because we do not have a choice to choose between the option. Ratio of the value of wages to the price of the product. Okay. If I divide by salary divided by the prices for the products that I buy. Okay. Salary divided by price. Basically, that is how we calculate real income. So this is actually a much better example of a real variable. Okay. When we deflate something by price, we take a ratio with the price. That is always the best real variable. So MCLR could have been a correct answer, good answer. It is very close, but D is better because D is very close to the formula of calculating real income or real variables. So that is why D is there. Otherwise it was tough to choose between D and C. Sometimes two options can be absolutely correct or very, very correct, but still some information will make something better than other. Okay. 7. Opportunity cost of growth is. Now we discussed the opportunity cost yesterday in the macroeconomics. Those who have not seen that session, kindly check out that session. The opportunity cost of growth is, what is opportunity cost? The next best alternative that I have. Reduction in current investment. For growth, what do I require? Growth require investment. Investment means from my income I have to keep some money separate as saving, which I will spend on something as investment. Okay. So reduction in current investment, no. Growth comes with the investment, not by reducing investment. Reduction in current consumption, that is correct, because I need to save money. I need to cut my, let us say, expenditure today and use that saving to put somewhere, and through that I can invest. Okay, so that is actually a good answer to this. But still we need to check C and D. There can even be a better answer we just saw in the previous question. Reduction in taxes, can't say. This is not relatable directly. Opportunity cost of growth is not, because growth can come even without any reduction in taxes, but it cannot come without investment. A reduction in current savings. A reduction in saving investment is basically same thing. It will not happen if this happen. So if D happen or A happen, growth will go down. So we are not dealing with the problem. So B is the correct answer. Okay. दिस इज द अपॉर्चुनिटी कॉस्ट. अगर आज मैं इन्वेस्ट कर रहा हूं तो उसके लिए मुझे क्या, व्हाट आई एम गिविंग अपॉन, व्हाट आई एम सैक्रिफाइसिंग. Simply think of opportunity cost as the sacrifice, the next best sacrifice that you are making. So in this case, you are sacrificing on your current consumption. Forget about national income. Think about yourself. You have a salary of 1 lakh. You can spend entire 1 lakh rupees every year, every month. And later on, you will not have any asset. Okay, you will not be able to buy anything because big. Unless you take a loan, because you are not saving money. But let us say you spend only 70,000, 30,000 you save. In few years, you will be able to save lakhs of rupees. And then you can spend that money on buying a small apartment or maybe a car, etc. So that is how you will buy an asset for yourself. So what is the cost for buying that asset in future or buying that car or anything in future? Is the cut in the current consumption. So consumption. Which of the following item is included while measuring the gross national product? Free YouTube classes. Is free YouTube classes included or not included in GDP? See, it is already written free. YouTube class itself may not indicate free. People may earn from YouTube through various associations, through advertisements, but since it is free, we consider it to be a very viable answer. Okay? Because if it is free, if I'm providing a service but not getting paid for it, it should not be part of GDP. It is the financial value of the production of goods and services. If it is for free, there is no financial value of it. Remember that formula. मैं आपको बता रहा हूँ, मंत्र की तरह याद कर लो. Remember it like a mantra. There are 5 components. Remember all the 5 components. Financial value of production of goods and services. Okay? It is financial value of what? Production. Production of what? Goods and services. In an area, during an year. That is how we consider. Buying of stock and share. Do we include stock and share in the GDP? Not at all. So this is also not included. YouTube classes should not be included, but again we are checking. Advertisement in newspaper. Advertisement in newspaper. Is it part of the GDP? Is it part of GDP? No. Why? Sorry, it is yes. Because it is a type of service. Newspaper charge for that. It is a service newspaper is providing to the businesses or anyone who is advertising. So you are hiring a service, you are paying for it. Then simply it is part of GDP. So C is part of GDP. Transferring of used goods. That is not part of GDP because used goods are not contributing to the production. Okay, it is simply the value of production in this year. This is not a production of this year generally. And even if it is a production of this year, its value was originally considered when it was new. It was sold originally. अगर उसके बाद कोई दोबारा बेच रहा है तो फिर तो हम डबल वैल्यू लगा रहे हैं. We are calculating double value if we are calculating it again in the same year. So used goods will never be included in GDP. So what do we not include? Second-hand goods we do not include in GDP. Gifts we do not include, and non-economic production we do not include. Either we are not providing goods or service or we are not getting paid. Okay, so that makes it a non-economic activity. Non-economic activities are not part of GDP. So in this case, C is the answer. Next, 9. Which of the following is not a flow variable? What is stock and what is flow? Stock, simply the criteria is stock is something which can be measured at a point of time. Flow which is measured over a point of time. For example, income. You generate income over year. महीने का कितना कमाते हो, साल का कितना कमाते हो, यही पूछा जाता है ना हमेशा. Everybody asks you how much you earn per month. I mean, your well-wishers, your family, relatives, etc. Okay, so how much you earn per month, every year. So they ask you for a duration, how much you earn. Earning is always a flow. It is over a period of time. They do not ask you, abhi kitna kamate ho. I mean, that is a wrong way of asking if somebody is asking that how much do you earn right now. By that, they again mean how much do you earn per month in the current situation at present in your company. But that doesn't mean in this moment how much do you earn. That is not possible. So even a moment also is a period if you consider. I'm going into speaking like a yoga guru, so I will not go further into that. So stock, something which we accumulate, जिसको हम जमा करते हैं. Stock means जमा करना. So which we accumulate over time. So capital is stock. We accumulate it over time. Then only we generate capital. Income is a flow. Which of the following is not a flow variable? So income is a flow. Since we are looking not flow variable, it is not part of it. Investment is a flow. Depreciation is tough to choose. Depreciation, what is depreciation? Do we accumulate depreciation? Yes, we accumulate depreciation, but depreciation is accumulated over a long period to replace something. But depreciation is allowed for 1 year. In this 1 year, machinery degrade by 10%, and we allocate money for that. So depreciation is also flow. It is tough to choose. It is much tougher than the previous three. But in this case, very clearly, it is also not part. It is also over a period of time. Over a period of time, point of time. That is how you should choose. In this case, answer should be 1 only. So C. Many of you might have picked up A in this, 1 and 4. Next question. Suppose the amount of output doesn't change in an economy, but the consumer price index CPI increases. What will be the impact on nominal GDP and real GDP? Okay. Output is not changing, means production is not changing. Only the price is changing, CPI is increasing. So obviously nominal GDP increases, real GDP doesn't increase. Real GDP is about production in the economy. So A is the answer, quite straightforward. You should be able to pick it out. Next, 11th, which of the following is not included in India's gross GDP? I mean, gross is already part of GDP. Which of the following is not included in the GDP? Okay, so value of final goods and services produced in the economy is included. Okay. B, value of intermediate goods and services, this is not included. Okay, intermediate goods are not included. Okay, for example, if I am already including the value of this pen, okay, let us say we produce this pen, 1 lakh units of this pen in 1 year. Now, do I have to separately include the value of the steel in this pen? No, the value of the pen includes the value of steel used in it. अगर हमने ये पेन बनाया, मैन्युफैक्चर किया, तो इसको बनाने में स्टील भी लगा, और जब हम पेन के लिए चार्ज कर रहे हैं तो स्टील की वैल्यू भी साथ में चार्ज कर रहे हैं. वी चार्ज फॉर एवरीथिंग दैट इज यूज्ड. सो इंटरमीडिएट प्रोडक्ट्स दे बिकम द कॉस्ट ऑफ द फैक्ट्रीज. दे include that within the value of the final product. So if we include both, there will be double calculation. So intermediary goods are not included. And by all these questions, your practice should now be complete. We have discussed a lot of questions, what is included, real, nominal, every kind of question we have included to cover the practice. Value of export is included in GDP. Okay. And D, value of import. Value of import is not included in GDP. Okay. So in this case, B and D should be the answer. Actually, there seems to be some error. I think I forgot to include the options here. Okay. So intermediary goods are also not included. Next topic is national income in India. Okay. I'm not going into the theory part. This is only for you to read. I will straight away jump to the questions for this. It is basically continuation of national income only. So far we were discussing concepts, now I am coming to India specific. The primary sector within a country for the calculation of national income include, even this is a conceptual question, small scale industry, is it part of the primary sector? Industry is generally part of the secondary sector. Okay, some industry can be part of mining. Okay, we can use that term in mining, but generally, so we go by general criteria, not go by exceptions. It is not part of it. Trading is tertiary activity. Agriculture is included in primary sector. So agriculture and mining, fishing which anyways is part of agriculture. So agriculture is part of primary sector, but not other two. Retail trading, of course not. So in this case, C is the answer. Which activity is included in tertiary sector? Tertiary means the third sector in which we are not manufacturing products but manufacturing services, or providing services. Mining is primary sector. Construction is secondary sector. Communication is tertiary sector. Trading is tertiary sector. Okay. In this case also, C and D actually should be both part of the tertiary sector. I think I prepared this question a little too quickly. Okay, in this case, it should actually include C and D. So, in case you were really confused in this question while preparing, I'm sorry, I seems to have made mistake in these questions here. Which of the following is used to adjust GDP for inflation in India? We mentioned that we adjust the GDP. Why? Because we have to convert nominal into real. And for converting nominal number into real number, we need something. We divide it by certain value. I divided by 120 in an earlier example. So same. What is that? Is that coming from CPI? CPI, of course, is our official inflation measure. We should be using CPI for deflating GDP. Is it correct? No. CPI is not used. WPI is also not used. It is GDP deflator. We have a specific indicator which we calculate for that purpose, and we call it GDP deflator. It look actually so simple that some of you may think itna easy nahi ho sakta. It can't be that easy. So that's why you might think about A. But it is actually that easy. The answer is very, very clearly saying adjusting for GDP for inflation, and it's saying GDP deflator. So this is basically the definition of C. But the point that it is so easy might create a doubt in your mind. Which of the following is a primary agency responsible for collecting and publishing official data in India? The answer in this case is CSO, Central Statistical Office. Now there is a change, of course, here, because we have created NSO through the merger of CSO and NSSO, but still it is within NSO also still, even after merger, they both exist as separate departments. So if NSO is there in option, we have to choose that. But since NSO is not there, CSO can be chosen. Next, which of the following survey is conducted by National Sample Survey Organization in India? Okay, NSSO conduct which of the survey here? So in this case, the answer is employment and unemployment survey. Actually, in this case, the census should give you an idea. Census generally means a much wider data collection. Generally, we are going to most of the people and collecting data directly. Sample survey, this was already very, very big and clear hint. Employment and unemployment survey. Okay, NSSO conduct that. Sixth, which of the following is a census conducted directly by the government of India? Okay, annual survey of industry. Question says census. So already I think that tells you that it can be either agriculture or economic census. So the simple point is that agriculture census is directly conducted by the government of India. It is the Ministry of Agriculture. Okay, so Ministry of Agriculture directly conduct agriculture census, whereas all the other are collected or they are done by specialized agencies. So directly, indirectly, that is also under Government of India, but directly by Government of India is agriculture census B. Okay, so seventh, which of these are direct factual questions, so I'm not spending much of time here, but still giving you revision for this. Which of the following is the largest household sample survey conducted in India by size? Where we go to the maximum number of people for data collection? National Family Health Survey, perhaps could be. Census of India, perhaps. In fact, for Census of India, we go to the most number of people, so that should be the answer. Because by size, the largest household sample survey. No, sample is the problem. Census is complete data. Census is not sample. Census data is not sample. Census data is complete data. So this is not considered. Since census is not considered, then answer is C, Consumer Expenditure Survey. That is bigger. Okay, although NFHS is more famous. Okay, we do not study this. We study this for our exam preparation also. So as a hindsight bias, it is possible you might choose A also, even if you have ruled out. And most probably you are likely to choose B if you forget about this sample written here. Okay, so C is the answer. 8. What was the new base year for calculating India's GDP after it was revised in 2014? So in 2014 we revised the GDP series. Instead of GDP at FC, we started using GDP at MP. Okay, and the new base year is 2011-12. Earlier it was 2004-5. From 2004-5 we changed it to 2011-12. We are due for a new base year, by the way. Every 10 years generally we change base year. So 2021-22 should have been our new base year, but that didn't happen because of COVID. Now, because COVID affected everything, so perhaps very soon we will have revision in the GDP series. Ninth, what was the main reason for revising the base year and calculation methodology of India's GDP in 2014? Okay, so base year is changed to update the weights. Okay, so A is definitely part of it. If base year was not part of the question, or then A would not be part of it. B, to reflect change in the structure of economy, that is correct. That is the part of the second. Okay, methodology was changed to reflect the structure. Both base year and this satisfies both of the points. And C, to improve the accuracy. So in this case all of these are correct. A, B and C. So answer will be all of the above. Okay, so that is why we update base year. Base year we always update every 10 years generally. In 2014 we changed it before the schedule. Okay, because the new base year was 2011-12. So it should have been 2014-15 if we go by the 10-year convention. But now convention is broken, and let's see when it will be updated next time. What is the name of the committee that was formed by the government of India to revise the base year and GDP calculation methodology in 2014? I think I mentioned it today. Rangarajan committee. Okay, so that is the answer. There is no discussion required. This is fact. Next, theory and growth models. Okay, the last topic in the macroeconomics that we are discussing. Phillips model, Lorenz curve, Gini coefficient, classical economics. Classical economics is part of the theory and growth, but this I will discuss with the budget. Keynesian economics also I will discuss with the budget. Okay, but these three I will discuss: Phillips model, Lorenz curve and Gini coefficient. I will also briefly discuss Lewis model, Harrod Domar model, Solow model and human capital model. Okay, and then we move ahead. So what is Phillips model or Phillips curve? Phillips curve is basically the relationship between inflation and unemployment. I will not go into the detailed explanation of the logic, okay, why there is a negative relationship between them. I will just give you a very brief idea here. So it says that a country, if it is suffering higher unemployment, then it should not be suffering higher inflation. When unemployment is under control, inflation should not be a problem. And when inflation is high, generally unemployment should not be the problem. When one is high, the other is low. Okay, for example here, inflation is high, but unemployment is low. Okay, or if you look at this combination here, inflation is low, but unemployment is high. So that is the type of combination we get. So we generally face one of the problem, not both together in a country, and this is true. Because when there is high unemployment, that means people are getting less income. Less people are getting income. There is less demand in the economy. And when there is less demand, then there should be lower prices. So inflation should not be happening at that time. There is also an alternate explanation. When there is high unemployment, labor force is easily available. Okay, people are ready to work at any wage, any salary when unemployment rate is very high. So you can get quality labor very cheap, and that is why production cost also doesn't increase. So you do not have a pressure to increase prices. So both aspects are there. So when inflation is high, unemployment should also not be high. Similarly, okay, when inflation is high, prices are rising. Remember supply curve. When prices are rising, a producer would like to increase the supply. And when a producer would like to increase the supply, what will happen? Producer will open more factories, try to hire more labor. So unemployment should fall down when there is high inflation. So that is the logic. Supply curve explains the reverse. So this is how the Phillips curve. But Phillips curve fails to explain the situation when the problem is from the supply side. When suddenly raw materials are not available, then nothing can explain. Phillips curve will not work. We will face stagflation. Okay. For example, after COVID, when production system collapsed, prices increased even if demand was less. People were not creating much demand, but since production was even lesser, the prices were still rising. So stagflation happens when problem is supply side, because Phillips curve is entirely based upon the demand analysis. But Phillips curve is quite accurate. Demand side problems it completely analyzes and explains. If economy does not have supply side problem, which generally is not the case, then one of the problems should be there in an economy. So this is the very important Phillips model or Phillips curve. Then there is Lorenz curve for inequality. So there is a 45-degree line on which there is perfect equality. Okay. On y-axis we have income. On x-axis we have population arranged in increasing order of income. So poorest and richest, that is how we have arranged them in the ascending order of income. So poorest 10% here, richest 10% here. But if we go by this imaginary 45-degree line, poorest 10% people get 10%. Poorest 10% people get 10% income. Richest 10% people will also get 10% of the income. Okay. So that way, richest get this, poorest get this equal. But this doesn't happen in reality. In reality, Lorenz curve is like this. It is like a convex lens below this 45-degree line. So far it is from this 45-degree line, greater is the inequality. I will make it again. Okay, these are the, let us say, I made a mistake here. I'll make it again. Just give me 1 second, please. I will make it. Okay, now this is curve X, this is curve Y. X and Y. Now curve X reflects less inequality, Y reflects high inequality. Let us see. The richest 10% people, on the curve Y, they get half the income. On the curve X, they get 25% of the income roughly. Okay, so this curve, whatever point is there on the curve, that gives us the distribution and population relationship. Okay, let us say if we look at here, 50% of the population, this is rich, this is bottom 50%. On the curve Y, the rich 50% get almost 90% of income. Okay, on the curve Y, whereas the poorest 50% get only 10% of the income. On the curve X, the rich get something like 80%. There is inequality, but there is less. Rich 50% get 80% of income. Poorest 50% get 20% of the income. So that is there. So the far off it is from the 45-degree line, greater will be inequality. So this is the Lorenz curve. In the Lorenz curve, population is arranged in ascending order of income. Income is simply there. So this is about Lorenz curve. It measures inequality. Then there is Gini coefficient. What is Gini coefficient? Again, I am making the Lorenz curve. It is derived from the Lorenz curve only. Okay, if this is my Lorenz curve, then area above the Lorenz curve is A, area below the Lorenz curve is B, and Gini coefficient will be A divided by A plus B. Okay, so if there are two curves like this, X and Y. In the X, A has lesser area, but in the Y curve, A has bigger area. Area above the curve is bigger. So this number will also be bigger. So this number vary between -1 to 1. Just give me 1 second, please. 0 to 1. 0 to 1. Accidentally I said minus 1. It varies between 0 to 1. Okay. So when, and 1 means higher inequality, highest inequality, 0 means lowest inequality. So higher the Gini coefficient is, higher the inequality is. Okay. So in the concept class later on I will discuss it in detail. Right now we are doing a revision class, so I am covering it quickly. So higher this number is, higher the inequality. Simply that is the concept, 0 to 1. Okay. Now coming back to the topic. Let us say if it is 0, that means A has to be 0, and if A is 0, that means there is no area above the curve. Means this 45-degree line itself is my curve, and entire area under the curve is same as B. Okay, so 0 means our Lorenz curve is same as the 45-degree line, and 1 means the Lorenz curve is like this. One person gets entire income in the economy. Okay, because 1 means B is 0, and area below the curve 0 means curve is like this. One person getting all the income. L-shaped curve will be there. So this is about Gini coefficient. Okay, so this is about the curves here, and let us move to the question. The growth models we will discuss with the help of questions itself. Let us look at the next question. What information can be derived specifically through the Lorenz curve? Inequality between countries? Yes, Lorenz curve measure inequality, but it measure inequality between countries? No. Within a country, between people. Does it measure inequality between social groups? What are social groups? Let us say urban and rural, man and women. On any kind of division we can create a social group. Scheduled caste versus OBC or any other. Okay, so these are all social groups, but can we get inequality between them through Lorenz curve? No, we can't get. Inequality between individuals? Yes. Every individual will be there in that population and will be at certain order as per their, so we can get at what percentage they are there. It's not the best thing. Okay. Inequality between individual is not the best answer, I am saying. If there would have been better answer, then I would have opted for that. So we have to look at next one. So inequality between regions. Regions, let us say states, cities, again not possible. So D is clearly not possible. A is clearly not possible through Lorenz curve. B is also not possible because we do not arrange social groups. Individual is still, it is not a good answer, but it is better among the others. So that is why I am choosing individuals. So C is the answer here. The meaning of disguised unemployment is, what is disguised unemployment? Hidden unemployment. And which model talks about disguised unemployment? It is the Lewis model. Okay, Lewis model say that there are following features of a developed economy or underdeveloped economy. Large traditional sector. By traditional he meant agriculture or mining. So basically primary sector, and small manufacturing or modern sector. And traditional sector has disguised unemployment. Means you put in extra people into agriculture or primary sector, it is not going to increase output because already there are more people working there rather than what is required. So that is what the problem is. That means we have zero marginal productivity of labor, zero total productivity of labor, zero average productivity of labor, or none of the above. How we should pick it up? Marginal means next or last. Means if we hire extra people or we add extra person to the production, the person is not going to add to output. So looks pretty accurate, looks like the answer. But let us look at the next. Zero total productivity means Entire labor in primary sector is not contributing anything, not possible. Total productivity is never zero, okay, unless you are in absolutely useless kind of activity. Okay, entire people are into drugs, then only we can say total productivity is zero. They are not doing anything at all in the day. Zero average productivity. Average productivity is total productivity divided by population. This will also means total output is zero. So this is also not possible. So A, which anyways appear to be good, is a answer. So A is the answer. Zero marginal productivity of labor. So this is one of the assumption of the Lewis model. Now Lewis model simply argue if any economy has this feature, then what it should do, it should allow migration of population to the modern sector and let it grow. So that is better for the economy. But we should keep in mind, under control, that the share of the manufacturing sector or the modern sector should increase over time and inflation is kept under control. Then only it will lead to sustainable growth. That is the Lewis model. We used it in India, okay, in the early stages of growth. The Harrod-Domar model, which we discussed when I was discussing growth, because you can't discuss growth without Harrod-Domar model. The growth is directly related to capital output ratio and inversely related to investment. I wrote that formula, growth is equal to investment divided by ICOR. ICOR is investment incremental capital output ratio. So we are not given incremental yet capital output ratio is given. So growth is indirectly, inversely related to ICOR, directly related to investment. So directly related to investment and inversely related to, I think this is very easy to pick up. You can very easily find it out. Fourth, according to the Lewis model, the dual economy means which has both type of sector, modern and traditional sector simultaneously, grow only when modern sector increases its output share relative to traditional sector. This is correct. Agriculture sector uses modern equipment, no. Lewis model very clearly say, whatever extra money you have, all the investment you make in modern sector, that is more fruitful. So you do not provide modern equipment to agriculture as per Lewis model. Okay, so second is incorrect. Agriculture sector hire less labor, that is correct. You need to free up labor from agriculture and give it to manufacturing. Wages in the industrial sector rises a lot. No, this will fail the model. This is what Lewis warns against, that this will create a problem. Okay, if the wages will rise too much, this will not work out. This is simply one of the conditions in which Lewis model will not work, and he has very clearly warned it. I also mentioned just that prices, inflation must be kept under control, because if there is inflation, people will ask for higher wages and then system will not work. And we do not have to go in more technicality why this is so. हमारे लेवल पे यूपीएससी के लेवल पे इतना बहुत है, it is enough for us. Okay, so do not go in technicalities of Lewis model. In this case, what is correct? 1 and 3. It should be D here. Okay. Next, in the solo growth model, what is the driver of the long-term economic growth? So, solo model basically argue that in the short run you might accumulate capital. Okay, that will give you growth, and in the long run, capital does not have that much of a big impact. In the long run, it is population increase, savings. Okay, your overall accumulation of capital, of course, still matters. Savings and capital matters, and technological progress, which is exogenous, which you do not control, which happens outside, that also matters. These are the three factors which lead to growth. So, what is the main driver of long-term economic growth? So, population growth matters, but it is not the main driver. Technological progress, according to the solo model, is the main driver of the economic growth. Capital accumulation matters. Okay, government policy is not part of the model. Which of the following is not a determinant of the long-term economic growth according to the Harrod-Domar model? Okay. Population growth. Yes, we consider savings rate. Savings rate will basically give us investments, because investment is very related to savings rate, directly proportional. Technological progress, capital output ratio. Technological progress is not part of this model. Okay, capital output ratio is. So C. Or sorry, I have written that it should actually be 1, 2, 3, 4. I think there is some technical error here. It should be 1, 2, 3, and 4. Okay, it should be 1 and 3 here. Okay. According to Harrod Domar model, even population in the long run will not matter. Okay, so it should be 1 and 3. So that was in solo model. I mixed up the two, I think. Next, which of the following is a key assumption of the solo swan growth model? Okay. Capital and labor are perfect substitutes? No. Capital and labor are complementary inputs? That is correct, but it is not the key assumption. Okay. Savings rate does not affect growth rate. Savings does affect growth rate. This is wrong. Technological progress is exogenous. This is one of the key idea. So 7th, that is correct. Okay, D is the answer for 7th. Again, I will discuss a concept class for the growth models also. So those who have doubts in the different growth models, I will cover them later on. Okay. In this class, it was a revision class. Those who already know the models, for them I have revised them with the help of questions. And there was one small error also I made in this Harrod Domar model. Okay, so here population growth, I was talking about solo model, so I actually considered that in the same flow. Market failure. Now this was a topic of the microeconomics, but I couldn't cover it then. Now I will cover it very quickly. So market failure. When does it happen? When the demand and supply curve, where they intersect, that point is not reached. Okay, this is the supply curve, this is demand curve, this is the market equilibrium. But we are not able to reach market equilibrium. This can happen because of a number of factors. Let us say there is a producer. Producers say, I will not supply below this price. Producers say, this is my minimum price. People at this price, this higher price, demand is only this much. People do not want to buy this much. Producer want to supply this much. So his supply curve is actually like this. But demand curve is like this. Okay, so market equilibrium, which could have been this, is actually this. So this is market failure. In this case, there is a problem with the output in the market. It is not optimum output. In this case, why it is not optimum? Because seller is ready to supply up to this much, but is only able to supply this much because demand is low. So all these kind of things can happen. Generally, it is not seller who do that. It is government which may do that. That there is a maximum price, there is a minimum price. Government say for something, let us say this is the supply and demand, supply, demand. This is, according to government, is the maximum price. At this price, supply is very less, demand is much higher. Now there is a problem. More people want this at low price, but there is not much of supply. Then what government do? It supply the cheaper product through ration shop. So ration shop is required because government has announced a maximum price. Because government has introduced a price regulation. So price regulation by government creates a market failure. Or sometimes too much of a monopoly power also creates a market failure. These are the typical condition of market failure. In private sector also, when a firm is able to influence market too much, that creates failure. Government is able to influence market too much, that also creates failure. Okay, so this is the situation. Now let us look at the question. Which of the following statement about minimum wages is true? Minimum wages is a price regulation. Okay. In this case, suppliers are labor. Industry is creating demand. This is the demand curve of industry. Ideally, industry would pay this much and hire these many people. But government say this is the minimum wage. According to government, this is the WM, minimum wage. Now at this higher salary, the demand from industry is much less. Industry is not interested in hiring people at very high salary. But supply of labor is much higher. People want to work at this salary in larger numbers. So there is greater supply but lesser demand. There is a market failure. There are people who want to work not able to work, okay, because this should have been equilibrium, but this is unable to reach because of government intervention. Now, minimum wage law may make some worker better off and other worse off. That is true. Some people get better income. Those who get job, they are better off. But there are many people who are not getting job at all. If there would not be a minimum wage, almost double the people would be working. But now only half the people are working. Okay? Because of minimum wage, this is the number of people working. Whereas originally, this many people were working. So there is a great difference. Roughly the number of people who are able to work has halved. So people who are getting job are better off. But what about people who become unemployed? They are not better off. So A is correct. Minimum wage law make employer worse off. Of course, employers are able to hire only this much, even if they wanted to hire much more, and they have to pay much higher to these workers. So employers are also worse off. Both A and B are true, none of the above are true. C is the answer in this case. Okay? So this is what happens. This is a typical market failure. Externalities occur. Externalities are discussed in macroeconomics. Okay? They occurs when, and those who have not attended the macroeconomic session, please attend that before this one. And if you are at this question, you do not know what is externality, go back to that video, okay, previous video, and then you come back to this. Because there I have discussed externalities. Market fail to allocate resources efficiently. No, this is market failure. This is where market is not able to utilize resources. Government intervenes in the market. This is also not externality. This is market failure. A transaction has positive or negative spillover effect on third party. This is the externality. That my action affects others. Others' actions affects me. Okay? So indirectly. I'm not even aware of how much my actions are affecting others. I'm creating externalities on others. There are too many buyers, too few sellers in the market. This is also a market failure. So other A, B and D, they are market failure condition. Sometimes this problem happens that I lose out the arrow here. Oh, they've shifted here. Okay, maybe this happens sometimes. Okay. A market failure due to imperfect competition occurs. Imperfect competition means somebody has acquired a greater power. I was talking about a monopolist. Firm has a market power and can charge higher price than under perfect competition. Possibly, there are too many firms in the market. No, this is not a reason for market failure. The government regulates the market. This can be a reason for market failure, but it is in over-regulation. Generally, government is simply regulating, doesn't matter too much. Market price is too low, not at all. A is correct here. A firm has a market power and it can change higher price than under perfect competition. Means there is not optimum demand or sale. So this is all about the questions on market failure. Market failure generally is not a topic which is very important for UPSC. So far questions have not come from this topic, but this is also one of the topic in macroeconomics and they can ask you questions. So I kept it there for very brief. Okay. So with this, I've covered all the questions for micro and macroeconomics. And in the coming videos, I will be covering the next video will be the fiscal policy, taxes, okay, questions plus current affairs. After that, financial markets. And those would be relatively longer videos. Okay. And if you like this content, do subscribe to this video and to this channel, sorry. And please share the video. Okay. If you are benefited, maybe your friends will also benefit. Okay. So support me and share these videos if you are happy with the work. And with that, I end this session. Thank you.